Bitcoin just hit 74,500. Ethereum crashed to 2,300. Then we got a massive reversal. Bitcoin bounced from 74,500 to $81,000 right now as I'm recording this pre-market. That's an 8.7% bounce from the low. Ethereum recovered from 2,300 to $2,680. From intraday low, Bitcoin is up 9%, while Ethereum gains 16%. Insane volatility, and we're waiting for US markets to open. In my previous videos, I laid out specific scenarios for Bitcoin using the S&P 500 as our leading indicator. The reason is clear. When large-scale risk sentiment shifts hit traditional markets, equities often move first, giving us a critical signal for crypto. My directive was to watch if the S&P closed the week above or below 5,800. I said if it closed below 5,700 to 5,800, expect that selling pressure to spread to crypto. It closed at 5,650. The lowest it hit was 5,520. I specifically warned that if it tested 5,500 or below, that would confirm significant weakness. Go watch the prior video. I am not making this up. This was the cornerstone of my bearish thesis. And what happened? We experienced that exact spillover selling. Bitcoin got hammered, dropping to $74,500. We then saw the relief bounce, a 9% move back to $81,000 in Bitcoin. Now, we wait for New York to open to see if this bounce holds or if the bearish scenario resumes. I read every comment from yesterday's video. Thank you. It's powerful to see you using this information to make sharper, more confident decisions. The split in perspectives was clear. Some of you are preparing for another leg down, while others are firmly anchored in the long-term crypto adoption thesis. That division doesn't signal confusion. It shows a community of prepared individuals, each executing their own plan. That's the core of what we do here. Independent thinking, not herd mentality. We don't sell fear, greed, or get-rich-quick fantasies about overnight millions. This isn't a scripted show with a predetermined happy ending. It's real markets and real risk. Now, a critical reminder for everyone, especially those new here. I do not sell signals, courses, mentorship, or any paid service. Anyone claiming otherwise is a scammer. Block them immediately. My only role is to provide a clear, unfiltered view of the markets. I operate solely on X and YouTube under this handle on both platforms. That is the only source for my analysis. I am not associated with any other accounts. Protect yourself. I will never ask you for money. Now, let me show you the current data as I'm recording this pre-market. Binance Spot is at 81,200. Binance Futures at 81,350. Coinbase Spot at 80,900. Coinbase Futures also 80,950. The premium between Asian exchanges and Western exchanges is minimal right now at $300. That's a 0.37% premium. This is down from the 12% premium we saw over the weekend during the panic, but it's normalized in pre-market. Crazy volatility, and we're waiting for New York to open. Here's what happened overnight and this morning. $1.2 trillion wiped out in just 3 days. Bitcoin is down 24% from its peak of $98,000, erasing $580 billion in market value. That's more than the entire market cap of Tesla and Meta combined. Ethereum crashed to nearly 35%, wiping out $280 billion, equal to the market cap of Walmart. Altcoins got obliterated with 40 to 50% losses across the board. Crypto is moving like penny stocks on steroids. This is the Fed hawkish pivot sell-off continuing. But here's what makes this different from a normal crash. Major institutions did not start selling Bitcoin. MicroStrategy did not sell. El Salvador did not sell. BlackRock's Bitcoin ETF saw inflows, not outflows. In fact, institutional adoption metrics are still accelerating. So why is Bitcoin puking so hard? There seems to be a disconnect between markets that trade Bitcoin. The second reason is someone needs liquidity and is selling crypto assets, which means a lot of paper shuffling going on, because absolutely nothing in the fundamental backdrop changed since Thursday other than maybe the banking system or a major hedge fund hit a major bump. The way Bitcoin is selling off while equity futures fall, bond yields dropping, and the dollar starting to show some strength. This isn't normal price action. It's stress. When Bitcoin is sold like this alongside gold, it usually means something is about to break. This is a liquidity crisis. In a true margin call event, funds don't sell what they want to sell. they sell what they can sell. Bitcoin and Ethereum are liquid, profitable positions for many institutional players, making them the first piggy bank to get smashed when the margin clerks come calling. Now, here's the smoking gun that proves this is forced liquidation, not fundamental breakdown. People in Singapore and Dubai buying Bitcoin OTC, not on exchanges because they want to avoid slippage. In Hong Kong and Japan, Bitcoin ATMs report record purchase volumes during the crash. In Europe and the Middle East, peer-to-peer Bitcoin volumes spiked 340% during the sell-off. People were still buying Bitcoin in Dubai and Singapore, even as prices plummeted, showing the extraordinary resilience in retail demand for crypto. Looking at the numbers, about 72% of you watching aren't subscribed. If this unfiltered real-time analysis is cutting through the noise for you, hit subscribe. If it adds value, drop a comment below. I'm here for those who want clarity and substance, not polished hype. Coinbase, one of the world's largest crypto exchanges, says Bitcoin withdrawal requests increased during the crash last week. Coinbase sees a growing divergence between derivative markets and spot markets and expects physical Bitcoin shortages on exchanges to exacerbate. Meanwhile, the current price of Bitcoin on China's largest peer-to-peer platform, Huobi P2P, is $92,500 per coin today. Binance is at $81,000. That's a 14.2% premium. Let that sink in. Huobi P2P, $92,500. Binance, $81,000, 14% premium. And Bitcoin funding rates are negative, meaning shorts are paying longs. You can't cure a huge demand for physical Bitcoin by manipulating the derivative price. The manipulation has nothing to do with actual Bitcoin supply and demand. It's to prevent a Western financial crisis due to choices made by those in power. Incredibly obvious. Whatever is going on behind closed doors must be truly big. Negative funding rates mean there is demand for actual Bitcoin, and all these shorts will have to close positions. They are playing a very dangerous game this time. We are in a crypto revaluation process where centralized exchanges are being drained of physical Bitcoin. All the shorters now care about is low paper prices while trying to cover derivative shorts and minimizing losses. At the end of this process, the full revaluation will unfold, and Bitcoin will be trading much higher, potentially reaching $150,000 to $200,000 as the halving supply shock combines with institutional demand. What's striking is how net volumes on Bitcoin futures at CME continue telling a whole different story. Yes, they tried to crash the price all last week till they succeeded, but the overall volumes are almost balanced outside large heavy dumps. It means the price is being driven lower by a combination of spoofing, mostly overnight hours, and wash trading during U.S. trading hours because the price was being forced lower that triggered derivatives unwinding on large ETFs like BITO and especially leveraged Bitcoin ETFs, creating the flush through stops. Needless to say, this has nothing to do with the spot market where fundamentals remain unchanged and the Bitcoin shortage on exchanges keeps worsening. Exchange reserves continue dropping. The on-chain parabola is still intact, but it needs to bounce here. CME Bitcoin futures hit circuit breakers twice yesterday, causing contracts to lock with heavy one-sided selling and very limited two-way trading for portions of the session. That tells you the U.S. derivative market is under stress too. But the exchange reserves are declining. The peer-to-peer premium is holding. Physical Bitcoin is not breaking. Only paper derivatives are breaking. Now, let's talk about what New York Open could bring. Two scenarios, bearish case first. If New York opens and the selling pressure continues, we could see Bitcoin test $74,500 again or go lower to $72,000. The 9% bounce from $74,500 to $81,000 could be just a relief rally before more downside. CME margin requirements increase today. If traders can't post the additional capital, more forced liquidation comes. The S&P 500 at 5,520 already confirmed the weakness I predicted. If it breaks lower to 5,400, that spreads risk-off sentiment to all assets including crypto. $8.4 trillion of corporate debt will mature over the next 18 months in the U.S., the most ever. This creates refinancing stress at higher interest rates. The corporate debt crisis is hitting a new level. This creates systemic stress that could trigger more selling across all markets. We're watching the everything bubble pop in real time. The Nasdaq is trading at its most expensive valuation multiples in history, higher than 2000 and 2021. A mean reversion there is terrifying, but expected. History tells us that during a deflationary crash like 2008 or March 2020, crypto gets dragged down with equities initially. When the selling in crypto stops, but equities keep falling, the bottom is in. Until then, the deleveraging will be brutal. That's the bearish scenario for New York Open. But here's the bullish case. The bounce from 74,500 to 81,000 is holding in pre-market. If New York opens and this bounce continues, we could see Bitcoin regain $85,000, even test $90,000 by end of day. Sharp drops are designed to trigger fear. That's how markets shake out impatient money. Bitcoin and Ethereum just saw a pullback, but the macro backdrop hasn't changed. Inflation, currency debasement, institutional adoption, halving supply shock, all still there. Corrections are normal and healthy. Volatility does not equal trend reversal. Bitcoin is nowhere near a top or bubble, severely undervalued versus its total addressable market. Bitcoin dominance is currently 58%. Historical bull market peaks see dominance at 70-75%. We're not even close. Exchange reserves at 2.1 million in Bitcoin, down from 3.2 million in 2020. That's a 34% decline in available supply on exchanges. Mining production is 450 Bitcoin per day post-halving. Institutional demand is 1,200 Bitcoin per day from ETFs alone. Fundamentals will take over the pricing mechanism soon. When that happens, Bitcoin explodes higher as supply shock meets unstoppable demand. People need to understand that in Western crypto markets, there are more derivative positions than real Bitcoin on exchanges. This sell-off is paper dumping to fool the masses into avoiding crypto when traditional markets collapse. Look how unstable Bitcoin is, but physical buyers know better. Singapore OTC buying, Dubai institutional flows, China and Hong Kong peer-to-peer at 14% premiums. Huobi P2P 14% premium. This is physical overwhelming paper in slow motion. The Crypto Fear and Greed Index registers 12, extreme fear, one of the most bullish contrarian readings possible. From a contrarian perspective, extreme bearish sentiment often marks bottoms, not tops. For those who saw value in Bitcoin at $95,000 last week, the current price of $81,000 could represent a significantly improved risk-reward proposition. That's the opportunity being presented by this volatility. Bitcoin is down another 6% from Friday's close, but from the $74,500 low, we're already up 9% to $81,000. So, what am I watching when New York opens? First, does the bounce from 74,500 to 81,000 hold, or does it fail and we retest $74,500? Second, does the S&P 500 stabilize at 5S9500 to 5,650, or does it break lower to 5,400? Now we see if the selling is done or if more comes. Third, do tech stocks stabilize or do they gap down hard and drag crypto with them? Fourth, does the Huobi P2P premium hold at 14% or does it compress? If it compresses toward 5% or lower, that signals physical demand is weakening. If it holds or expands back toward 20-25%, that signals physical is strong and paper derivatives are losing control. Fifth, do we get any news on bank stress, Fed policy shift, or geopolitical tensions? Any of these could move markets violently either direction. Where does this leave us? Number one, physical and paper are completely disconnected. Singapore and Dubai buying OTC as prices crash. China and Hong Kong peer-to-peer at premiums. Huobi P2P 14% premium. Bitcoin funding rates negative. Exchange reserves declining. This is not a fundamental breakdown. This is paper manipulation and forced liquidation. While physical demand increases, the divergence between paper and physical is growing, not shrinking. At some point, one of these markets breaks. History says it's paper that breaks, not physical. Number two, New York session will tell us if $74,500 was the bottom, or if more selling comes. The 9% bounce to $81,000 is encouraging. Ethereum up 16% from lows. Bitcoin up 9%. But we need New York to confirm. If the bounce holds and builds, the worst could be over. If it fails and we retest $74,500 or go lower, more pain ahead before the bottom. Watch the open closely. The unresolved tension is this: Bitcoin hitting $74,500 with a 9% bounce. But does New York confirm this is the bottom, or is this just a relief rally before more downside? Physical markets are screaming strength. OTC buying, premiums, negative funding, declining exchange reserves. Paper markets are screaming stress. Forced liquidation, margin calls, wash trading. Which one wins when New York opens? Do your own due diligence and understand the risks, as this volatility is extreme. Leverage trading in these conditions carries exceptional danger. Think for yourself. Use your own brain. Don't follow blindly. This is real risk. While some are observing a significant divergence where a paper market selling contrasts with physical market tightness, it is critical to interpret this carefully. The recent low of $74,500 may present an entry point for some, but it could also simply be a pause before further decline. New York will tell us. Stay sharp, watch the data, invest with logic, not hype.